Yeah, I got it. It's okay. You are the brave few that have decided that Accounting 101 is going to be worth an hour of my time. And it's my responsibility to make sure it is worth an hour of your time. So we'll see how we do. If everybody's ready to rock and roll, I don't know if you needed something on your side to push a record button or whatever happens over there. We are good to go. Okay, ladies and gentlemen, let's get rocking. Accounting 101, welcome. Thanks for having me. My name is Chris Stubbs. I'm the Director of Accounting for ASAP Accounting and Payroll. This is Dina Williams, my colleague. She's the Director of our Vacation Rental. Some of you have probably already seen Dina. She is our rock star of Trust Accounting. She's quite literally the Paul McCartney and John Lennon of Trust Accounting, which is a weird thing to be the Paul McCartney of, but there it is. And so, super happy to have you. So today, what we're gonna do is talk a little bit about the basics of accounting. My goal is, by the time you leave, to give you some fun tools that you can use right away to kind of evaluate where your business stands, the health of your business, the well-being, and the opportunities that are in front of your business. Our company was founded in Telluride, Colorado, so we feel we really know the destination markets, and that's really our bread and butter is the destination markets. Example, how many have had this experience? Guest checks out, sends you a review. Oh, this was the greatest place in the world, super short walk to the beach, great shops, loved it. But the TV was small, 3 stars. Been there? I literally had somebody, after 40 straight 5-star reviews, give us a 3-star review, and I quote, "The kitchen knives weren't sharp enough." Yeah, thank you so much. But we recognize your pain and suffering, and so we know what you're going through, and that's what makes us ASAP. So, accounting and finance, okay? So sometimes those two words are stuck together, right? You'll hear people say, oh, it's an accounting and finance thing. Well, today we're gonna separate those two words because they're really, I recommend as a property manager and entrepreneur, you start thinking about those as 2 different hats. You got your accounting hat, and you're gonna have your finance hat. Your accounting hat is the accounting is the study of the truth, okay? What we do in accounting is we record what actually happened. Not what was supposed to happen, but what actually happened. If you write a check, say you write a check to the electrician, but you meant to write a check to the plumber, okay? You write the check to the electrician, he refunds your money, then you write a check to the plumber, okay? Now you might think to yourself, well, in the end, money left my checking account, the plumber got paid, who cares? As accountants, we can't have that, I'm sorry. And that's why nobody likes accountants, because we're the ones gonna record that check one way, record the deposit the other way, record the check the other way, and in the end, yes, you're right. Money left my checking account and the plumber got paid. But accounting is the study of the truth, and in accounting, we mark what actually happened. Now, finance, on the other hand, finance is probably what most of you like to do. That's the hat you put on when you're scheming and dreaming. What happens when my company goes from 10 units to 50 units? What happens when an opportunity comes to sell my business? What happens when an opportunity comes to merge with a similar sized business? That's finance. It's all number driven, but it's more about strategy. It's more about trends. It's more about analysis. And so today what we're gonna do is we're gonna talk a little bit about accounting, and we're gonna talk a little bit how it connects to finance. I'm hoping I will give you some cool finance tools that you can take back to your properties and you can start watching, and I think they'll really help you grow your business, okay? So, as I said, accounting is the study of the truth, and we're gonna be looking at our financial statements today and talking about the construction of our financial statements and what that truth is. But there's one in particular, because we're at live res, one line item we want to kind of address first, and that is this accounting, operating accounting versus trust accounting. Okay, so what is the difference? Let me flip this one back. What is the difference? Okay, operating accounting. Operating accounting is just that word, operations. You are paying bills, that is an operation. If you're paying the electric bill, that's part of your operation, okay? Your trust accounting is other people's money. It's the easiest way to think about it. This is your advance deposits, okay? Now your money is in that. There's a piece of that advance deposit that belongs to you once that reservation is resolved. But in the beginning, once you accept the advance deposit, you've kind of engaged in a contract essentially with your guest that says, in advance of your payment, I'm promised that I'm gonna provide this experience for you, okay? And so then, as you guys know, later on, that trust gets broken, that trust account gets broken, and then all those buckets have to be split apart. Who gets this money? Who gets that money, okay? So it's really important to know the difference, because you don't want to be paying your electric bill with somebody's security deposit, okay? So keeping those two things, keeping the truth of those two things separate is really, really important in the short-term rental market, okay? And so we're going to look at that in a little bit more detail, but, well, let's put it this way. If you're commingling, and I'm not going to call anybody out, so if this is happening to you, don't worry about it, we can help. If you're commingling your operating and your trust accounts, I would say it's kind of like you're standing on the train tracks and there's a train coming. Now the train might not show up for a week, or not might show up for 2 years, but it's coming. And what that train is its opportunity, and you're gonna get run over by that opportunity. Because if you go to sell your business and your trust account's out of whack, it's gonna devalue your business, okay? If you go to the bank and say, I have an opportunity to buy a bunch of new properties, if your trust account's out of whack and commingled with your operating funds, you're gonna have a real hard time convincing that bank that you know what you're doing. If somebody comes and says, I wanna merge with you, and your operating account's all out of whack and your trust account's a mess, it's gonna, again, devalue your company. So when I say that train's coming, I'm gonna, without even having to raise hands, I know everybody in this room is interested in growing their business, and I also know everybody in this room doesn't wanna work till they're 90 years old. So these two things are the truths that are part of that train. And so making arrangements today for the idea that you don't wanna work forever and you wanna be able to get out in a productive way, that's a great motivator to try to separate those two things in case they're together right now, okay? So make that a goal of yours to separate the trust account from your operating account. Keep those two things clean. Okay, so today we're gonna go into, with the idea of truth in accounting and your finance hats handy, we're gonna go into the financial statements and how to read them, what they mean, and how to use some tools around them to help grow your business. Okay. I'm going to skip this one. We're going to get back to it in a sec, because this is some best practices. Let's go to financial statement. There are 3 financial statements you really need to know to run an effective business, no matter what the business is. You could be a dog groomer, you could be a vacation rental business, you could be Coca-Cola. You have to be able to read 3 financial statements. First one's the profit and loss statement. The second one is the balance sheet. And the third one is the statement of cash flow, okay? And we're going to go through each one of them today. So we're going to start out with the profit and loss statement. Good news, bad news. Good news, profit and loss statement, super easy to understand and almost intuitive in the world of business. Bad news, it's probably the least valuable of the 3 financial statements we're going through today. And we'll talk a little bit about that in a minute. But let's just take care of the nuts and bolts of a profit and loss statement. So at the top of a profit and loss statement, you're going to have the income section, okay? And that's exactly what it means. It's income. You'll hear the word sales, you'll hear the word revenue, sometimes you'll hear the words top line revenue. It all means the same thing. Sales comes into your business. It's what you sold, the money you're taking in, okay? Second section is the expense section. What did I spend, right? So money comes in, money goes out, and the last section calculates itself. It's what's left over, right? It's just really that easy. Money comes in, money comes out, profit and loss at the end, okay? So then let's dig into it a little deeper, because there's sections, right? So at the top here, we've got income. Now you can break out your income like this is done. We have got rental commissions, owner reimbursements, cleaning fees, processing fees. You as a management team will decide how you want to view your revenue, okay? So in this is just some examples, but there's no rules here. If you want to just throw your cleaning fees into an operating fee, and maybe you have a different fee. Maybe you offer catering, and there's a catering commission or catering revenue in here, okay? So you should look at your team and look at what revenue streams are important to you. They're all going to roll up into that total count that says total income, okay? But it's really up to you. You can pick anything you want and just load them in there. Second section, we talk about expenses. And you see in this case, the expenses are broken into 2 sections. There's a section called cost of goods sold, and then there's a second section called regular expenses or operating expenses, okay? The difference here is cost of goods sold are your expenses that are directly related to the sales. So in other words, think of it this way. If the sale never happened, those expenses would never happen, okay? Maybe it's a cleaning fee. If you use an outside cleaning service, they charge you $150 to clean a unit. If the unit doesn't rent, they don't work, you don't pay them, okay? So that's a cost of goods sold, okay? So it changes, it's variable, okay? And that produces something called gross profit. And the reason they look at gross profit, you'll sometimes hear the word margin, okay? What is my margin on my sales? My margin is just the gross profit divided by the total income, okay? That's what you make every time you sell. So in the case of the cleaning fee, you sell the unit for $500, you have a $100 cleaning fee, okay? And that just happens every time the transaction happens. The regular expenses on the bottom, these are ones that it doesn't matter if that unit ever rents, that you are going to pay the utility bill. Okay? Even though the utility bill might tweak up and down a little bit because of the usage, it doesn't stop. The electric company sends you a bill whether you book all your places or none of your places. Okay? Yeah?
I'm sorry, can you say again, the gross profit divided by the
total sales
the total sales
is your margin.
margin?
Yep. 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 So that is how it's broken down. You got two expenses to look at, your variable expenses and your operating expenses. Now I'm gonna give you one trick to look at right away as a business runner. You're gonna wanna watch your operating expenses. A lot of people will just focus on that top revenue number and go, did I sell more than last year? Did I sell more than last month? And that's valuable, but you can also make money by watching those expenses. The number one I'm gonna tell you to watch is that insurance number. Make it a policy to review your insurance policy. You might be best friends with your insurance agency, but they have a tendency to creep up on you. So 2 to 3 years, always review your insurance policy, have it bid out.
I'm sorry, just for clarity, I got a little bit lost. So you're calling the variable expenses are the ones,
Yep.
the 6,000
Nope,
numbers?
variables are the 500s. Cost of goods, cost of service.
Okay, so those are my variable, and then my fixed are,
Yep,
okay, so even though I can modify my insurance expense.
you're gonna have
You're
insurance.
gonna have something, okay, something.
There's gonna be something in that line. You can tweak it a little bit, but you're always gonna pay insurance, okay? But certain fees are directly related, like cleaning expense in this example, are completely related to turning over a unit,
Got it.
okay? So the last thing I wanna look at, the profit and loss statement, and again, we're gonna talk, we got our accountant hat on right now. And so the accountant hat's on and it's gonna say, okay, this one says net income of $213,000. Okay, great. There's some other income items down at the bottom, okay? What is other income? Okay, so other income is income that is kind of not what you regularly do. Example, I had a customer, they're in the Midwest, they have rental units, they have about 400 acres, okay? Lumber Baron comes down the road and says, hey, I noticed an old grove walnut, down your street. Would you mind, in your back acreage, would you sell me the lumber? And I'm gonna go take down those walnut trees. So my client says, yeah, sure, that'd be great. $10,000. This guy comes, cleans out thing. So his profit and loss comes in, and he calls me up and said, boy, I had a great March. I made $12,000 in the month of March. We're usually dead in March. I'm like, well, you actually only made $2,000 because you sold $10,000 worth of trees. And you're not in the tree business, right? Those trees aren't gonna grow back next month and you're not gonna sell them again, okay? So that's when we talk about the truth in accounting. And so when you look at your profit and loss statement, take a look at areas that are marked as other, okay? Those are the areas that, hey, it's real money. He sold those trees. That money's in his checking account, good for him. But you shouldn't make financial decisions next year thinking you're gonna make the same money in March of next year. So again, it's look at your other income and your other expenses to make sure it's the truth and you're looking at what your company did and what your core business did and not just the total that somehow fell to the bottom. And that's what you'll see other income and other expense being. Do you have a question about that?
I did, I'm sorry.
No, fine.
So if we're gonna have like a one-off sell trees kind of thing, do you suggest making like a 70-20 that just says
Yeah.
like
So you'll see,
random sale and then?
yeah, so you'll see down here, I'm gonna slip over here real quick, net operating income. Net operating income is your income from operations. That is the income from your regular business, what you normally do. This section, other income, This is stuff you don't normally do. You're not in this business. It still might have generated money for you, but the idea is maybe it just happened this one month and will never happen again. Maybe it happens every 3 years. You shouldn't bank on it is the idea, right? And so even though it adjusts to 213,000 instead of 210, the real number when you're making decisions, when you put that finance hat on, you should be looking at 210 as your real number.
Okay, so but basically you're not categorizing anything to the categories that don't have numbers in front of them.
Those are totaling accounts. So those happen automatically. In this case, anything without a number, this is a total expense. 211 is the sum of all these numbers here. Sorry if I'm standing right in front of everybody. So. Cool. So that's profit and loss, okay? So now earlier I said this is the least valuable statement of the three. The reason it's the least valuable statement of the three is because this statement looks backwards, right? This is what happened last month or maybe last quarter, okay? This is driving by looking through the rear view mirror. You're going forward. This is last month. And we'll tell you as accountants, you'll probably already know if you're doing your accounting work, your bank statement might not come into the 5th. Your credit card statement might come to the 7th. Your merchant processing might come in on different. So it might take you to today, which is October 13th, to close your books, all right? So now here we are, it's October 13th, and this is September, right? So we want to, this is valuable information, but it's also in the past, okay? It's important to document it, and that's accounting, but how do we turn this document into a more proactive document? Well, then we're going to slip on our finance hat, okay? So here's some tricks to turn this document into a good document. First thing you want to do, compare it, because most of us are in seasonal businesses, right? You want to compare September of this year to September of last year, okay? That's a valuable statement, right? What did we do last September? What are we doing this September? That's called year-over-year analysis. And you're just going to put them line by line next to each other. They're mirror images of each other. And you want to look at the difference. So for example, in this example, let's pretend this is a September statement. It says insurance expense was $10,000. If you run it for September of 2020 and it says $8,500, well, that's a point of contention, right? That's something I need to look at. Why did my insurance go up by $1,500, right? That line by line comparison, super handy. So that's your first step. Second step, trend. So when we talk about finance, a trend is super powerful data. Now, when we look at seasonal businesses, it's hard to look at trend because if the previous month was just an off month, then the trend could be all wacky. So you should look at year-over-year growth month to month. So in other words, this could be September of 21. You should look back at September 20, September 19, September 18. Look back 3 to 4 years and take a look at some of your big numbers. Number one, look at your total revenue. What was your total revenue in 2018? Was it 19, 20, and 21? And what is the trend? Is it going up? Is it going down? And then ask yourself that question, why is it going up? Why is it going down? Use the same analysis on all the subtotals. So on your gross profit, look at that. Is my gross profit going up or down, right? And why would that be? So like if your sales are growing up, but your gross profit's going down, you would ask yourself, well, which of those variable fees are going out of control? And maybe your cleaning fees have doubled in 4 years. That might be an analysis, right? So first thing you want to do is look at the previous year, and then the second thing you want to do is look at maybe the previous 2 or 3 or 4 years if you have the data. And the third thing you want to do to make this super powerful is a statement called the forecast statement, okay? And all a forecast statement is the exact same document. It's the absolute mirror image, but you're plugging in numbers because you think you'll be doing these sales, right? So, for example, here we are in the 4th quarter. What I would recommend as an exercise, like today, I would say, I'm going to sit down, look at some of my historical data, and I'm going to plug in a forecast for the 1st quarter of next year. And then, when the 1st quarter of 22 ends, so I'm sitting around in April, I'm going to pull up this exact same spreadsheet and look at what we actually did and then what I thought we would do. And then ask myself the question, what did I get right and what did I get wrong and why? And those are valuable tools to bring to your team and say, hey, I thought our cleaning bill would be $13,500 and it turned out to be $16,000. What went wrong, guys? What went right? So look at each one of those things. So that's how you turn a static historical document into a finance document that you can make management decisions off. Look at what you did last year, look at what you did 2 or 3 years in terms of the trend, and look what you thought you'd do. And that's the real important one. Now, that's a discipline exercise, right? Because then you're on this rotation. You're always looking a quarter ahead, 2 quarters ahead. And then as you do that exercise, you'll get better at it. And then you'll be able to make future decisions. Because then you'll be looking ahead and saying, hey, I'm pretty confident that I'm going to tell you what we're going to do in the 3rd quarter of 22. And so I know where my money's going to be, and therefore I can go out and make some good decisions. So that's a good way to look at your profit and loss statement. Questions on that?
Does QuickBooks contain a
Yes.
place where I can plug in future profit? Like
Yep.
Okay.
If you use QuickBooks, they have budget and forecasting tools. You can run reports and include the budget. You know, QuickBooks is really good at that.
Is it separate from budgeting?
You can use the budgeting tool.
Then it would function.
It
Okay,
functions
cool.
the same. That's how I generally use it.
Yeah.
But,
Okay, cool.
okay, any other questions on profit and loss before we head to the balance sheet? Everybody good with that? Cool. Making me feel confident. Balance sheet. Now, this is my favorite one. I know everybody's like super excited. How could that be? So the balance sheet tells you 2 exciting things. The balance sheet tells you, how is my company doing? Which is a great question. We ask that all the time. How am I really doing? Well, that data is in the balance sheet. Second question is, where are my opportunities? Well, the balance sheet also holds opportunities, okay, if you know where to look and you know how to read it. So let's start with how it works, and then we'll go into how it tells you how healthy you are, and then we'll tell you about how to find your opportunities inside this statement. So number 1, how does it work? It works almost like the profit and loss section. It's got 3 sections. In this case, the first section on the left side of the screen is called assets. This is things you own. This is your stuff, okay? Could be cash in your pocket, could be a tractor, could be property. If you own it, it's an asset, okay? Second section is called liabilities. Liabilities are what you owe. You might owe sales tax. You might have a credit card bill. If you owe money, it's over there on the liability side. Could be your mortgage, if that's built into the business, okay? Then the difference is your equity, okay? Think of it like owning a house, right? If I own a house, I put a down payment down, I own that portion of the house, the bank owns a portion of the house, that's your mortgage, and what's left over is your equity, okay? And so that's the core of the balance sheet. Now, if we break it into the next level, which is like we did with the profit and loss statement, you'll look a little closer. I'm going to start with the asset side. You see current assets and you see fixed assets. Current assets are what they call, you might have heard the term liquidity or liquid assets. If it's current, it's a lot closer to cash than something that's fixed, right? So in other words, you might have a car, you could clearly sell the car, but it's going to take some effort and time to turn that car into cash. But if you look at the current assets here, first 2, bank account. Well, that's real cash. You don't have to convert everything. It's actually at cash. The second area under current assets is accounts receivable, okay? And guest accounts receivable. That's money that's coming your way. You've got a pretty strong feeling in your hand that's going to turn into cash pretty quick, right? Certainly within the next 12 months, those items are going to turn to cash. And then we start looking at the fixed assets. In this case, they've got $25,000 in furniture and equipment, okay? Okay, it's an asset. I own that furniture and equipment, but if I needed to turn it to cash, somebody's got to sell it, right? It's going to take some time. And so as you keep moving down the fixed asset list, the assets get larger, like land, buildings, tractors, all that kind of stuff. And so they kind of get slower in terms of their conversion to cash. And so that's the asset side of the balance sheet. Liability side works the exact same way, okay? The current liabilities are things you owe in the next 12 months. You got to pay these bills. This is credit card bills due next month, right? So your accounts payable, your credit card bills, those are current liabilities. Other liabilities, known as long-term liabilities, are going to be a commercial loan, a mortgage. Anything that's longer than 12 months is considered a long-term loan, okay, or long-term liability. So that's how we look at our balance sheet. So this gives you an idea of where's my cash at right now, what bills do I got to pay right away, and then what's the big picture. And then the difference is the equity. You'll see owner distribution. That's money that the ownership has taken out of the business. And you'll also see retained earnings. Retained earnings is money that the company has made but is not distributed as of yet. okay? So that's what sits there. Did you have a question about the balance sheet?
I did. For the assets, the trust accounts is listed,
Mm-hmm.
and then on the other current liabilities.
Yep.
So, okay, so is that how they're kind of balancing each other? Because
Yep.
I don't currently have my trust account on my current assets for my balance sheet.
Okay.
So is it better to have it in there?
Well, yes, because it's money you're in control of right now.
Okay.
Nobody, go ahead.
My recommendation is once a year. You want to post, and you'll notice on this one, the trust assets, so you have your trust bank account and your accounts receivable equal your trust liabilities. They are the same, because that's what you do with your trust account. And those numbers come right out of LIFO, so this is very specific to your industry.
Can you say, are you talking about the 67,500?
And the 34,000. See the other asset down there,
Oh,
live trust,
yes.
guest accounts receivable, those two
Okay.
numbers together equal the total of the live trust liabilities. So once a year, you wanna post that for live trust, for your
Okay.
operating account for your CPA,
Okay.
at the end of your fiscal year.
Okay, got it. Didn't know that. Okay, now I'm understanding. Thank
Good,
you.
no, perfect example. Okay, so then how do you take this document and answer the question, how's my business doing? Super easy way to do that. A little bit of mathematics involved, but it's easy, okay? Take a look at the line called total current assets, okay? Again, that's gonna be your cash and cash equivalents and receivables, okay? And we're gonna divide that by the current liabilities. So in this case, total current assets, 341,000, current liabilities, 113,000. Okay, as business people, we know we want more assets than we want debt, right? So the question is, what is the ratio between the two, okay? And in this case, the ratio is about 3-to-1 for easy math, right? Okay, that's a great ratio. That's anywhere above between 1.5 and 3, you're in good shape, okay? That means you've got enough assets, enough cash coming in to cover your debt, right? So that's good news, okay? If you did that same mathematics and saw the number was 1 or below 1, that means you've got more debt than you have assets, and you need to probably start looking around and determining what's causing that, right? Because if your debts are going up and your assets are going down, you're gonna have trouble making your bills. So the reason you wanna look at this on a consistent basis is this is a forward-looking metric. And so we're looking in the future. We're looking 30 days, 60 days, 90 days. The current liabilities, the current assets, that's called the current ratio, easy name to remember. If it's in this case 3-to-1, you're in good shape. The question, the question it answers is, what is my ability to pay my bills in the next year? Can I pay my bills for 12 months? If I can, in this case 3-to-1, this company's in good shape. They're gonna be fine. Now, there's a second level to this. If you really want to drill into it, you could say, I'm going to take just the cash position. I'm going to just look at the bank accounts, okay? With the idea that no one's ever going to pay me for what they owe me, okay? So that's 285 to 113, okay? So that's a ratio of whatever, 2.4, okay? Again, great number, no problem. You know you can cover your bills for the next 90 days, and you know you can cover your bills for the next year. So your company's in good shape moving forward in this scenario here. If you see those numbers get 1 or below 1, then you've got some adjustments that need to be made. Then you've got bills that maybe, what I would recommend, maybe your current bills, you need to talk to your bank about consolidating your current bills into a longer term debt. I see that a lot with somebody that's got 6 darn credit cards over there. Those 6 credit cards are all current liabilities, and that ratio gets out of balance, and I say to them, let's take those 6 credit cards and go to the bank and find one good 5-year loan to clean this up and move forward, okay? So watch those current liabilities to current debt.
And is there any rule of thumb, you're mentioning like 1.5 to 3, is like, if I was magically at 7 to 1, is that saying?
That's
I'm
my next,
investing in it? Okay.
now my next, no, don't be sorry. Great question, because that's where we're going next.
Okay, good.
If you did that same math and it was 7, that means you're sitting on a boatload of assets and they're probably not working very hard for you. Because if you're sitting on $700,000 in cash to $100,000 in debt, I would say to you, you only need 100 to 150 to cover a year's worth of expenses. What are you doing with the rest of the money? Why is it sitting in your checking account, right? So that's why we say that 3.5, above 3.5, we start looking, we start asking that question, and that's when I said earlier, What are the opportunities that the balance sheet provides you? Well, that's one of them right now. Do I have too much cash? Which is a cool problem to have, right? So if I've got too much cash, I might say to myself, well, this might be a buy opportunity for me. Maybe there's something else in the market. Now, there's also some hidden opportunities in here. We do only recognize your assets at the price we purchase them at, right? So this is an interesting real estate market we're living in currently, right? So maybe 10 years ago, I bought a vacation rental property for $200,000, okay? And it's providing me $50,000 a year in rental income. Cool, bought it for 200, it's providing me 50, that's a 25% return on that asset. Cool, I couldn't get 25% in the stock market, so I'm pretty good with that. Unless it's taken up all my days and I'm working 80 hours a week to maintain that, I'm okay with that. Now, here's a weird thing. Now let's go into 2021 in the current real estate market. We're in the vacation rental areas, right? That $200,000 house might now be worth $1 million, okay? But if it's worth $1 million, but it's still only giving us $50,000, well, now my percentage has gone to 5%. Well, wait a minute. 5% return on, and I'm doing a lot of work as a property manager, right? I've got to keep this thing up, got to keep a roof on the place. This is the opportunity that sits inside your balance sheet to review your assets, to say, what is each one of my assets worth, and am I getting the return on them? Think of it like a stock, right? If I bought a stock in Disney, I expect a rate of return, and I'd watch the stock market to see how Disney's doing. Think of your properties, your units, your doors, as stocks. I bought $200,000 worth of 123 Main Street, USA. What is my return on that? And what could I sell that stock for today? Now, I will say I'm not a tax person, so you definitely want to talk to your tax advisor. If you have a $200,000 house you're going to sell for $1 million. But the exercise I'm going through with our finance hats on right now is to say, hey, let's take a look at our assets. Because it could be, well, maybe I'm not charging enough rent for this. So if I take what used to give me $50,000 and pop it up to $200,000, now I'm back to my $1 million place is giving me a 20% return, and I'm a super happy person because I'm making a lot more money now. But if there's a ceiling in your market that says, I'll never get more than $50,000 out of this property, then looking at the value of the real estate and saying, then this challenges each one of you as a manager and as an entrepreneur. Because I'm saying to you right now, okay, you've got a $200,000, you got a $1 million property that's not returning very well at 5%. It's one thing to say I'm going to sell the darn thing and I'm going to take that $800,000. Second part of that equation is if you do that, I got to challenge you and say, what are you going to do with the $800,000? Because if the answer is I'm going to stick it in my checking account, well, then you're actually doing better at 5%, right? So as entrepreneurs and as business people, we need to be thinking about how to manage our assets and to make sure that we're getting what we want out of them. And then we always need to be having our finance hat on thinking, if I pulled that equity, if I pulled that $800,000 out, do I have an idea in my head that I think is going to be doing better than 5%? So it's something to think about as you look through your properties. But that story exists inside your balance sheet. So 2 things to do when you look at your balance sheet is you want to look at that current ratio, debt to equity, make sure you're in good shape there. And number 2, every once in a while, you don't have to do it every day, but every once in a while, just take a little review. Never hurts. You'll always get a real estate agent willing to stop by your place and tell you what all your properties are worth. But take a look at that, and it doesn't have to be just real estate, right? I got people in agriculture that have tractors, tractors buy and sell all the time, Think about how your assets are performing, what the maintenance of the assets are, and are you getting the return you guys want out of them? Okay, let's take a little pause here because that's a lot of information. I know this is a 101 class. That's kind of wading into the 201 pool a little bit, but you guys all seem like you're on top of it, so I wanted to give you that tool. Okay, questions about analyzing the balance sheet and what it means? Okay, not too much. So good. So before I leave the balance sheet, I'm going to put my accounting hat back on. This is a statement, because we've got our accounting hat on, we need to talk about the truth, right? And so what is the truth? All these decisions that we just talked about, that opportunity maybe to sell a property or move some money around or buy another place, well, it absolutely depends on that this is the truth, right? Because if this is wrong, your decisions are inherently wrong, okay? And so we need to make sure it's the truth. So you'll hear a lot about account reconciliation. That's a very common thing. We talk about reconciling your trust account, which Gina just mentioned, and reconciling your checkbook on a monthly basis. But others, you can reconcile every number on this page, okay? Doesn't have to be a checking account, right? Reconciling your credit card account, that's a common one. People do that one all the time. How often do you reconcile your long-term debt account? Are you double checking that on your monthly statement that that number on the balance sheet matches what's the bank thinks you owe, right? Because if you think you owe less money than the bank thinks you owe, the bank wins that argument. So that means you're out of whack, right? And mostly sometimes that's just unrecorded interest payments that, somebody just puts an amount down and doesn't record the interest correctly. It could be just an adjustment, but again, you can reconcile those accounts. Now the two that are important, super important, that don't get reconciled as much as they should is your accounts payable, who do you owe, okay, and your accounts receivable, who owes you. Now, accounts receivable, this is that moment of truth again. Right now, our accounts receivable says people owe us $22,000. We have to be honest about that. So one of the things is if you sold Uncle Bob a tractor for $10,000, you sold it to him a year ago, and Bob doesn't seem to be coming up with the money, well, then that's not a real number, is it, right? So you have to make sure that that's an honest number. And the way the bank does that, they look at what's called the aging, or how old are your receivables. If you've got people that have owed you money for 90 days or more, a bank will not consider it real money, okay? So if you go to the bank and say, hey, here's all my assets, well, they're gonna look at the detail of your accounts receivable, and if it's got Uncle Bob in the tractor that's 180 days old, they're gonna go, yeah, no, we're not gonna count that one, okay? And you shouldn't either when you're doing that analysis of the current assets, the current liabilities, right? Because if you're counting money that you honestly in your heart know that Uncle Bob's never gonna write you that damn check, then let's be straight about it. Let's get that off the books and make this the truth, okay? Now, 3 years from now, Bob wins the lottery and comes up with $10,000, there's no problem. We can put that into other income like we saw in the profit and loss statement. Thanks, Bob. Okay, but that's the accounting and that's the truth. So before you start making decisions about selling properties and moving your money around and getting loans and going to the bank, you really want to make sure that you're making decisions on the truth. Okay, go ahead.
I have two questions with the equity. What does retained earnings mean?
Retained earnings are money that the company has made but is not distributed, right? So we had a profit of $45,000 over time,
Okay.
but we haven't written a check for $45,000. So it's sitting inside the company as equity.
But it's not in my savings account.
Nope, nope.
So
It's money you spent. We're going to get to that in the third statement called the statement of cash flow, and it'll show you, it'll answer that question.
and then my other question, if you don't mind, is I have something that's owner investment and it says capital and then each of the owner's names. Is that the same or is different than owner
Nope.
distributions?
Oh, no, okay, owner's capital is money you put in to start the business. That's kind of your down payment in your own business.
Okay.
Where this is owner distribution. That means the owners of this company has been paid out $60,000.
Okay.
Okay.
So I might have something misnamed here.
I do want, or hope we can clarify here, the profit and loss is a picture in that time period that you run the report for. These are rolling ongoing numbers forever, they don't reset when you take
Right.
your dates.
Yep. So what happens, see, at the end of the year, you're going to make money. See, this says net income of $213,000, and that connects to the $213 in profit, right? So this company made $213,000. On the equity section, you see the net income of $213. When the year rolls over, if none of that money is distributed, it becomes part of retained earnings, and net income resets to zero for the next calendar year.
That's where your retained earnings came from.
Yep, so that 45,000 retaining years, depending on the age of this company, if this company's 10 years old, that's just a rolling number over the 10 years that just keeps getting added into there until somebody says it's time to take money out of the company, okay? Okay, we're gonna move on to the last one, which is great news, because this has been a lot of information. Everybody's head's a little swimmy with all that kind of stuff. The good news is if our accountant hat fits well, and we have told the truth on the previous two statements, then the last statement auto-populates. It does everything automatically. You don't have to do anything. Sweet. All you have to do is read it. So let's get to that one. Statement of cash flow. Okay. This answers one of the most common questions accountants get. My company made $213,000 last year. Where the heck's my money? Why isn't there $213,000 in my checking account if I made $213,000? That's what the statement of cash flow is about, okay? It tells you where your money went. And in this case, we start out with your net income from operations. So we made $213,000. And then we've got an accounts receivable, okay? What that means is we've taken the money you've made, but we're adjusting it downward because you haven't collected that money yet, right? So I made $213,000, but people still owe me money. So that number there, the accounts receivable, is the change in position of your accounts receivable over this period of time. So it's one thing to say I sold $100,000 worth of stuff, but if you only receive $75,000 in cash, then your cash position goes down. So that's the number one reason why you can answer the question, I made $213,000, where's my money? Well, I tell you where your money, Uncle Bob still owes you for that darn tractor. Go talk to Bob, you know. So there you go, $25,000. Now you do an upward adjustment, in this case for credit card. Credit card, in this case, I've used my credit card to buy things. So I've marked that expense, but I actually haven't paid for it, right? So I would reduce my credit card by the 15, or in this case, increase by 1,500 to say, my cash position from 15 to say, okay, somebody else is, you know, holding that money. I bought a bunch of stuff, improved my assets, but somebody else has it. So again, change in position, okay? So now we get to net cash provided by activities. So you can see where that adjusted. So we made 213, but now I'm down to 189. That's what cash I have, right? And now we make some more adjustments. What did we spend that 189 on? Well, in this case, the first one is the new business loan. The principal payments, not the interest, because you can expense the interest payments, but you still owe the principal on the loan, right? So some of my money went to pay off the debt, in this case, $12,000. So there goes $12,000. Owner distribution. One of my owners cut him a $1,000 check. Okay, there goes some of my money. Net cash provided by financing activities, $13,000. Net cash reserves for the period at $176, okay? The last one says cash at the beginning of the period. That $41,000 is from the previous year, okay? So you started the year with 41. You made 213. We made all these adjustments to 176. Your cash position at the end of the period is 217. So the answer would be, where is my money? I would say to you, well, we should be able to account for $217,000 because that's what you should have made over that period of time. And so that's what the statement of cash flow answers that question, where the heck's my money? Okay, so questions about the statement of cash flow, the profit and loss, or the balance sheet? Any of those exciting things? Go ahead, Amy.
When you say that this auto-populates for the financing activities, does something like QuickBooks look at the date of the loan and put it on here?
No, it's just going to look at your transactions. Every time you post a loan payment, it's
okay.
going to throw it right into there. Yep. Automatically. If you use QuickBooks, it's already there.
I think we should clarify when we talk about owner distributions here, this is the owner of this vacation rental company, not
Right.
your owners in my.
Oh, yeah, that's true. That's good. Very good point. Yeah, this is the owner of the company. We're talking about the company picture, really, not the individual property managers. Okay. So before I get to questions and this, I'm going to back up to a slide. So you can take some pictures. As I said, this is all about the truth, right? So the question is, what are my best practices so I know my profit and loss and my balance sheet and my statement of cash flow is as accurate as possible? And here's some great examples of operating account best practices, okay? Transaction coding, are my expenses going where they belong, right? Don't plug the electric bill into the plumbing bill. Even you could call them both repair and maintenance, that's fine. But don't plug the plumbing bill into interest income. You know, let's make sure everything's in the right box, okay? Answer those questions. Bank reconciliations, credit card reconciliations. I also mentioned accounts receivable reconciliations, accounts payable reconciliations. Go through that balance sheet. Take an exercise. Maybe, I don't know, everyone has sort of, I hate to use the word slow season because I've never known anyone in a seasonal business that recognizes something called the slow season. It's more the catch-up season. So during catch-up season, you know, take a look at that balance sheet. Go through those things. Make sure that you're looking at it as the truth and it makes sense to you. Financial statement review, you know, whether you do that internally or with an accountant or with your CPA, take a look at your statements, right? Because if you're bank account on your balance sheet's in the negative, well, you know that's a mess. Let's get that figured out. Annual posting of assets and liabilities from trust. That's what Dina said earlier, reconciling that trust account, making sure it all lines up cleanly. Everybody got a picture of that one? Good? Trust account best practices. Dina, you want to roll that one?
Yeah, sure. I mean, I think I've covered it a bazillion times in the last couple days, but if you haven't seen it yet, these are what we would recommend for best practices in a summary form. So you want to make sure you're posting all of your expenses, your payments, you're doing your bill payments, putting your liability detail report, grouping all of your deposits, doing your bank reconciliation, reviewing your statements, publishing everything for all of your stakeholders, very important. Doing your annual tax filing, 1099 processing, so just very general best practices. Yeah.
My question is, I know we've talked about, because you've got our live trust system, reconciliation, all that, and then with QuickBooks, which I'm really stuck at doing, should we have a QuickBooks that's that's based off of our rent trust accounting that we pull from live trust and then an operating QuickBooks, or are we only just doing our operating account QuickBooks?
Your trust accounting is all in live trust, and then your operating accounting is all in QuickBooks or whatever operating accounting system you use. And then just once a year, you're just posting the balances from live trust. You do all of your reconciliations for your trust accounting in live trust, and all of your reconciliations for your operating accounting in your QuickBooks file.
So, I don't know how many other people do this, but we're, full service property management company, so we have long-term properties and short-term properties. So, what's I'm being able to reconcile, I guess, all of the stuff that we're pulling in from our long-term property management side, in addition to all the stuff that we're pulling in from.
So your QuickBooks file might have the long-term bank accounts in that. That might be where those are reconciled. So for your, you maybe have long-term security deposits or first month's rent. You have a bank account specific for those. That would be reconciled in QuickBooks, so it would be on your assets in your QuickBooks account. Okay.
And then another question, retained earnings. So I'm the owner of the company, and
Yep.
it's an LLC.
Yep.
Retained earnings for an LLC, they're not really retained earnings, are they? Anything that's above what the expenses are is considered pass-through income. Is that correct?
Yes, but retained earnings on your balance sheet, if I can find that again. Sorry. Okay, so retained earnings are, because it's a pass-through, you've paid taxes on that. It's passed through directly to you. It's your income. It's not, but potentially even though you paid taxes, for example, on this $45,000, you might not have taken the $45,000. You still have to reckon, because you might have said, I need that money to keep inside the business to grow, to operate, okay? So what retained earnings, the key phrase in retained earnings is, it's undistributed funds. Doesn't mean it hasn't been taxed. In your situation, it has been taxed. Yeah. You just haven't taken them. So you've paid taxes. The idea then to...
So I have to adjust the retained earnings for the taxes that I pay on?
Nope. You've already paid the taxes. That happens on your personal. That flows through to your personal return, okay? The idea, though, is down the road, if you now, 2 years later, say, I'm going to take $10,000 out of the business, you don't take $10,000 out of the business and pay taxes on it again, right? So I'm going to write a check, and I'm going to reduce that retained earnings, so you get to pull money out of the business because you've already paid taxes on it.
Good question.
It's an excellent question. If it,
Accounting 201.
yeah, sorry.
Yeah,
Who's,
right.
yeah, we all slipping into 201 there, so we got our accounting hats and our finance hats, right? And the finance hats look cool, and they go with our outfits, and they're awesome. The accounting hats don't look cool, but they're important. So, other questions I can answer for you about accounting, analysis, finance, profit and loss statements, balance sheet, any 101. And you can just, it doesn't have to be about anything we saw today. You've just got some accounting 101 questions you're dying to ask. And don't be shy. This is a friendly group. I'm sure nobody will laugh. Go get them, Patrick. What do you got?
So we are in the process of trying to get all of our company financials moving into Live Trust.
Mm-hmm.
It's been live since July. So currently in our Live Trust, it shows we have several different transactions, and I know that we need to go back to do our initial reconciliation before we can release our
Dina, best practice.
Yeah, you should do the initial reconciliation now. Did you have a trust account prior to Live Trust?
Yes.
Okay, so you'll finish that initial reconciliation, whatever system you have it currently, and then you're gonna redo the exact same reconciliation again with your initial reconciliation. Live Trust, you can do it now.
Okay, perfect, thank you.
You're welcome.
Great question.
What if I did my initial reconciliation and maybe one or two reconciliations when I first started this 2 years ago, and then I just gave up?
Then you're gonna do what I would call maybe a second initial, you're gonna do very similar, what we, suggest for the initial reconciliation, maybe 12/31 of 2020, and you're gonna post your ending balance 12/31/2020 and select everything on the reconciliation, literally everything. Unselect the things that are gonna clear in 2021, and then have to write off the difference. To
Have
yourself,
you guys do that?
the manager. You can absolutely give us a call.
Yep.
We'd love to help you.
Did I mention she's the Paul McCartney of this? You see how little I talk when she talks. What else can we help you guys with? Anything else? Anybody else? Anyone else that wants to share a terrible review story?
We do have Kahoot.
Oh, I'm sorry. Yes, there's a game to be played. But wait a minute. Let's ask that question. Does anyone want to share a head-slapping, what are you talking about review? There we go, right down here.
We actually had somebody lovely condo, great view, everything was perfect except the weather.
Oh, that's a. I'm sorry, you obviously missed the boat with that customer. You couldn't control the weather for them.
So I know that for me, it's been our vacation rental agreement, that they had a great stay. We even gave them early check-in for free, some other stuff. But then they came back and gave us like 2 stars because they felt our vacation rental agreement had too many rules and that they would be charged, even though after their stay, before they did the review, we even refunded the deposit, no charges, anything like that. But because of the rules, they felt that they couldn't enjoy their vacation.
We were on pins and needles the whole time.
The whole time walking on eggshells around your amazing property. I, yeah.
Our city limits that nobody can play music outside at all if the vacation room is open.
Oh, wow.
You cannot have a door open if you're playing music inside.
Oh,
It's strict in Palm Springs, so we get that all the time, that they had a great time, all this, but the rules imposed by the city, not by
right,
us,
right.
so strict that they could not have a great time.
Oh, that's tough. Wow. Well, it's an interesting game because you guys have all been in that situation where it's like they have these glowing reviews, and my pet peeve was always the TV because I'm like, really? You're going to spend this kind of dollars to have a beachfront property for 7 days so you can watch television? Like, just stay home. Oh, that's just me, though. Okay, so
The worst one is that they say, oh, we had a perfect vacation, and what did they give you? A 3. Everything was perfect.
Right,
There's
and they
all
don't
that
say
so
why.
Yeah.
You'd be surprised how many
Oh.
of those we get. And Matthew writes back to them, and why did you give us a 3 if everything was perfect?
Yeah, that was frustrating.
it is tough. So again, my name is Chris Stubbs. I'm with ASAP Accounting. This is Dina Williams. If we can help you guys out in any way, we're always available. Love to chat. We're sitting outside here eating candy, so please stop us from doing that if you can. Other than that, you can reach us anytime at vraccountingpros.com or just give us a call. Or if you're in Telluride, Durango, or Golden, Colorado, stop by one of our offices. We'd love to see you and love to talk. We love the industry and we love the people that work in the industry. So again, thanks everybody. We're gonna have a game, as I understand.
We are.
Oh,
So
sorry.
you'll wanna get out your phone or your computer.
Laptop.
Yeah.
All right.
Is that time again, and we have a little game, it's shorter, 6 questions.
We're gonna go to www.kahoot.it. It is shorter, Christina's right.
Came to get the third
Patrick wants the whole collection.
He said he has to complete his set, so.
You guys have some serious competition in here today, so it is based on correct answers and then speed. So if you're a fast reader like our friend Patrick, you're gonna do well.
Also, for those of you who haven't stayed, remember the question will pop up at the top and then in the middle. So make sure you look, if you didn't see it the first time, it'll be in the
And
middle.
it'll be on your screen too, right?
No, they can see it on up
You
here.
can see it up
That's the
here
question
and,
up there.
yeah, I think both, yeah,
Got lots of people logged in. This is exciting.
Very exciting.
It's very stressful.
Do you wanna play?
I'm afraid to play. What if I get it wrong?
Yeah, it shows up.
Oh, hold on. Still logging in.
Well, it's a made-up word for them.
Orange cannot open this page. Oh, that's right, you don't, can I move on my computer?
Of course. I'll wait for you.
All right.
www.kahoot. All right.
So is Palm Desert as tough as Palm Springs in terms of, or is it?
KAHOOT.
Oh.
Dot it. Hoot.
Mm. Palm Springs is such a cool destination, so I understand why people want to go there. I go every Christmas to Palm Springs, so I love it. I will get his card now that I know where to stay. Yeah. Which is not good because I like music.
822402 in there. Type in here. Click. There you go. Once you put the code, put your name.
Makes it feel like if they actually read it, then they're probably gonna be, okay, hey, they understand part of it, but
All right, Ruby, we ready?
Okay, here we go, gang.
All right, guys, we're ready. There's only 6 questions for this one. Again, it goes off of correct answers and speed. All right?
Get 'em.
All from the Accountant 101. There's no sound on there? So, Patrick.
Oh, but Max is on his
Uh-oh,
heels.
Patrick, Max, and Amy. Yeah, they are tied.
All right, Michelle,
Next
come on,
question.
comeback story. Let's do it. Good. Got the jams on it now. Ooh, all over the map. And, oh, Amy.
Patrick's still holding on. Amy, you're knocking on the door. Question number 3.
Yeah, she is.
All right. Michelle's on fire, but it hasn't changed. Okay.
Oh.
2 more. Nice. All
Hi,
right.
everybody.
Patrick's on fire, but Amy is knocking at the door. This is a very close one. It's still anybody's game, so this is definitely going to depend on speed for this last question. Let's go. 2 more questions, rather.
5 or 6. Here we go.
Nice. Patrick's not letting go. He's not letting go. Last question.
go.
Here we go. So our third place winner is Max. Go, Max. Second place, Amy. Woohoo! Amy's third trophy. And first place, Patrick completed the set. First place, congratulations.
Nice. Well done, Patrick. Yeah, really, like live trust die.
Can I get a sash and a crown?
Absolutely.
Here's Amy's Live Trust Boss Participation Award.
Wow.
Fun story, she got back to her hotel yesterday and her kids had like decorated the hotel room and put her trophy in there.
That's amazing.
That's a big celebration.
Max, congratulations.
An honor just to be nominated.
Oh. And Patrick, you completed the set.
I could have done it with
Oh, let me show.
boarding team.
Oh, well, thank you so much. Let me show everybody your light up, beautiful first place.
Let's see. It is 12:31. Look at that.
Congratulations.
Professionals. Accountants always on time.
You guys did amazing.
All right, guys.
You're
Again, I'm Chris. This is
welcome.
Dina. You have any
I need a
questions at
picture.
all? Happy to answer them. Really enjoyed meeting you all.
I need a picture with you. At
Have a
least
great
once.
afternoon. Enjoy your time. Oh yeah. We'll do that.